Hey, everybody. Welcome back to another episode of the Work Hard, Invest Harder podcast. I'm your host, Justin Dixon, and today we have Trey Taylor on the podcast. He runs his own family office called Threadneedle, the Taylor Family Office. And this is going to be a unique episode because we dive into what kind of family offices and high net worth individuals are investing in. We talk about how they are putting together a syndication for a potential Major League Baseball expansion team. We talk about kind of some of the journey that he's been on from being a lawyer and now coming back in and having to run the family office. We dig into a book that he wrote called The CEO Only Does Three Things. So really, very interesting episode. Definitely some actionable things for people, even if you don't have enough money to have a family office like myself. So I think you'll still get a lot out of this episode. So let's get Trey on the pod.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
All right, Trey, welcome to the podcast. Happy to have you on, man.
Justin, good to see you, man. I'm a fan of the work that you're doing. We got some mutual friends as well, so it's a great honor to be with you.
Yeah, no, I'm excited to unpack your journey. So let's start there. Let's kind of talk about kind of what you're doing, where you are, and then we'll dig into some stuff.
Yeah, so I think but I run a family office. It's a single family office, meaning that we are managing internal family wealth for my family for the next three generations. We have three generations on board. And so the charter that we've set for ourselves is to sort of, make those longer term decisions that will benefit the next three generations of the family. We do that in a lot of different ways, different verticals and investments. And I'm sure that we'll unpack some of that as we get into it.
Yeah. So how did you get into the family? I mean, obviously it's your family, your money, and all of that. So I guess how did it come to about where you started a family office versus working with a financial advisor to kind of outsource the management of your wealth?
Yeah, I think it's a great question. So, and I get this question from people like, how do I know when I'm sort of big enough to do it or what have you? So I answer it a couple of different ways. One, we had three catalyzing events that happened within basically 45 days of each other. We were super early investors in Airbnb. They went public in maybe February of 20. We had a big piece of real estate on the coast in Jacksonville, Florida that was undeveloped, and we sold that. And then we lost a family member, a Gen 2 family member, who had a lot of real estate, younger kids, and had a ton of life insurance. So what may feel like a good problem, we had a lot of liquidity happen within about 45 days.
Got it.
And so that felt good for a week, and then, the creeping fear of like, what are you doing with that money? How are you making it grow in the future? Inflation's coming, all of that sort of thing. So we began interviewing large multifamily offices and was so underwhelmed by, the value prop that they were giving us and the things that they wanted to sell us and the fees that they were sort of charging. I just didn't think it was the right thing. So I called the family together and said, I think we ought to do this on our own. And I will run it for the first 3 years. I'll learn the business from the ground up. I have to step away from some of my other obligations. So long answer to a short question, in 2019, we formed Threadneedle, the Taylor Family Office. And then we've been in deployment mode basically since then.
Yeah, I mean, having a lot of liquid money is a problem. It's a good problem to have, but it is a problem if you want.
It's better than the alternative, right?
That's right. Yeah. That's right. But it is a situation where, even right now we're recording this in early November 2023. Having a lot of people that I talk to, whether they're high net worth people or work with funds and things, they're trying to keep some powder dry, just given what's going on in the world that I mostly spend my time in, and that's the commercial real estate space. So having a little powder dry is probably a good thing at the moment to prepare yourself for any really good low-hanging fruit, distressed opportunities to jump into. So
I completely agree. And just so you know, the average family office is keeping 38 to 48% of capital in cash right now, cash in short terms.
Got it.
When you can make a deposit in a bank and get paid 5.25% on a money market, with very little systemic risk associated with that, you're still under inflation, but at least you're protected against asset depreciation, which is probably what we're going to see in the next 3 years or so. Yeah.
Yeah. And obviously, having your money in the bank, earning a 4 or 5%, risk-free, interest rate is kind of nice versus, having it in a checking account, which is earning no percent, right? So at least you're catching something. So I'm curious. I'm always curious about people's journeys. Kind of yours is a unique one because most people that I talk to work a W-2 job and then they find real estate at some point in their life and they say, okay, I want to start to either passively invest or actively invest in real estate. And that's kind of an inflection point for them to kind of think differently, right? Because most people, when they think about investing, they think about stock market, company 401k. Those are typically the two things that people talk about. So I'm curious, kind of once you started to learn the family office space, where did you kind of go? And obviously it sounds like your family has had experience and exposure to real estate. So I'm just kind of curious how that journey kind of started. And you said you started that in 2019. Is that right?
The office itself started in 2019. Now we had made investments and co-investments with family members for decades. Yeah. So my grandfather, who's Gen 1 for us and founded the family firm, who just passed this year and willed his assets into the family office because he believed in the structure that we were putting together. He just didn't want to be told how to invest his money. So he waited until he was gone to do that. But, and that's a very typical thing for Gen 1. So he had always taught us growing up that, equity ownership is the only way to build wealth in this country. And I remember being, sort of in the 5th or 6th grade and going to the beach with him on spring break. And he had one of those sort of Vietnam era cell phones, that looked like he was going to call in an airstrike or something. Right. And he hung it up and he said, boys, I just made $5,000 today or something. And my brother and I both said, no, you didn't. You've been on the beach with us all day. And he said, that's the lesson that I want to teach you. Right. So we own insurance businesses. We pour the excess of that, and historically has gone almost exclusively to real estate, single family and multifamily, and some commercial, sort of 80-20 from that standpoint. So we've been doing that for 50 years as a family.
Got it. And so you only manage your own money, right? You're not looking or bringing in other people's capital into the family at this point.
So we have sort of a loose syndicate of other families that we show investments to. So this morning I had an all hands with about 5 offices. We have a really intriguing offer, 2-prong offer to join a syndicate forming an MLB expansion team. And we have a Hollywood studio deal that is available to us now. And before we formed the office, these deals never found us. Yeah. Right. But because we've consolidated assets and said, instead of buying somebody university education and somebody gets a Range Rover and somebody gets a pool and then that money is gone, we've held that corpus back, consolidated it, and then brought in other families around our size to come in and take down some of those offers together. Yeah. And then you get better offers, you get better, returns over time, that sort of thing. So whereas we used to be W-2 guys doing fix and flips and those kinds of things, we just leveraged and rolled that. There's nothing wrong with starting there. That's where we started. But it gets to a place where if you consolidate it and have this generational mentality, then you can really get into some interesting and hopefully very high returns.
So I'm going to kind of take a little diversion here. How does one get involved or get access to an MLB expansion opportunity that's just too unique for me to not just touch on for a few minutes?
So, those things are always done. Like when you see it in the newspaper, it's too late to invest, right? Well, right. Like you say, oh, that's a done deal. But how did that deal get put together? Well, it's a network of people that, that know each other. That have done some deals together on the smaller side. We didn't pick up the phone and call every family office we've ever seen or worked with. We picked up the phone and called the 5 that we've worked with that have gone to work when we put money to work, that didn't just sit back and wait they put their networks in play. They've done that sort of thing. And so when the organizer of this specific team expansion said, "Hey, I think I've got a shot at making it. We want to put a team together." Five of us called five other people, and so we got about 60 potential investors to raise $300 million from. Some of them are very, very large offices. We are not, but some of them are. And so that's how that sort of stuff comes together. It's and think about it. It's no other investing circle, right?
Right.
A guy that you partner with on hard money, for example, might bring you into another deal and say, "Hey, I loved what you did there. I can't do this. Can you do it?" Those kinds of conversations always happen, but it's always built on trust, and it's always built on a commitment of, I'm here to make my partners money. I'm going to earn from that, but I'm here to make my partners money.
Yeah, well, it's the whole old saying, what your net worth is your network kind of a thing. And if you're, to your point, like you doing smaller deals yourself is where you start, but then eventually you get to the point where you're a little bit bigger and you talk to bigger people and you kind of can, work with different partners, and then you can kind of scale your business that way and get access to deals that you wouldn't have gotten years ago, right? When you're kind of just starting out. So
exactly.
I want to kind of talk a little bit about how, not everybody that listens to this podcast, myself included, has a family office, right? So I want to kind of think and maybe pick your brain on how can somebody think about a family office mindset when they're trying to just think about what investments they can do and what investments they have access to at the present moment. But before we dig into that, I want to take a quick sponsor break, so we'll be right back.
Whether you're trying to hire a full-time employee or a contractor to fill a gap, Hire Tomorrow can help. Hire Tomorrow is a boutique recruitment firm that has successfully filled sales and marketing, human resources, and technology positions with companies ranging from startups to Fortune 500. If you're struggling to find the right talent, check out hiretomorrow.com or reach out to recruiting@hiretomorrow.com to see how they can help.
We are back on the Work Hard, Invest Harder podcast. We've got Trey Taylor on. So before we kind of jump to break, you were kind of just giving us a little bit of rundown on what you've been up to in this family office. And so trying to take it back to some actionable maybe insights or thoughts as somebody who doesn't have a family office, but they have some cash. They want to figure out how to invest in kind of alternative assets outside of the general stock market, 401k, all that fun stuff. So, you kind of stepped in and said, "Hey, I'm going to run this family office." You had a lot of liquidity that you needed to deploy. And obviously part of that deployment is to legally avoid paying some taxes and kicking that can down the road and all that fun stuff. So, if somebody's sitting here and they're like, "Hey, I've got, a really good job, or I own a business and I'm a CEO myself. And, I've got a couple $100,000, dollars sitting in a 5% earning savings account," right? How should you start thinking about maybe generational wealth or just ways to protect yourself by investing in some different asset classes?
Yeah, a bunch to unpack there. So the first day is, when we tell our story, a lot of people say, "Oh, I want to do exactly that." But I'm sort of Gen 1 and I don't have, the resources that would be considered that way. And I don't have buy-in from the other generations of the family. Either they are older and they don't have the correct resources, or they're the same generation as me and they want to do their own thing and not together, or they're kids that really can't make the decision. And my assertion is that the family office is not the solution there, right?
Yeah.
But it doesn't mean that you don't invest for the benefit of your family long term. So I just want to really point out that that's two different sides of the highway, I think.
Yeah.
And being in a family office, for better or worse, means that my bosses are the people that benefit from the co-investment action that we do together. And that can be tricky. Like in any family business, it can be tricky to know that I got to wake up Christmas morning, and somebody expect a big distribution, but the business didn't perform or something like that. Normal human beings in this country don't have to deal with that. We've had a long 60-year history of doing it. So that's the first thing that I would caution, is just to say, you don't have to do a family office to deliver a lot of the same thing. If you have the ability to consolidate multiple family members' portfolio under single governance, then maybe that's a thing that you should do. And I think, different people have different opinions on this. Some people say it's 100 million. or more. We do not manage $100 million. So we are running that structure in a very different way for a lot less than that. But, I think about 20 to 30 million in relatively liquid or investable assets is the path to decide maybe it's time to go the family office route.
Yeah.
Let's be honest, most of us don't have that. So there's a different path that I think other investors should be taking as they build up to potentially having that, or being Gen 1, or handing it to Gen 1 to form that office later on.
Got it. So I guess assuming that people listening to this don't have 20 to 30 million kind of in investable assets to manage, maybe they have $500,000, $1 million, right? And they're like, okay, maybe they had an event, right? Maybe they sold a business and they, got a check for $1 million. How do you think about kind of diversification of that? And then what type of assets are you looking at? And maybe let's kind of dig into the real estate side, because that's mainly where I tread.
Sure.
You mentioned kind of single family, you mentioned that you did fix and flips, and that was kind of probably earlier in the journey, but yeah, where are you thinking about kind of the opportunities are in the real estate world?
Yeah, and it's a great question, and I can answer it from a family office standpoint, and then just remember that I invest my own money as well. Yeah, and so I still do fix and flips. I've got a wholesaler who calls me twice a week with deals, and we go look at every single one of them, and they may be a $55,000 deal. But if I can take and flip that thing, or if I can double wholesale it or something like that, and put 10 grand in my pocket for making a phone call, I will do that all the time. I'm a deal hustler. I love my deal anyway. So if I was in that situation where I had those things, the first thing that you mentioned, 401k, is I don't like qualified money. So I can always do better than the government can mandate me to do. So I get it out of a 401k or any of the qualified money as soon as I can. And your financial planner may have a completely different opinion on that. If I can't do that, then I definitely want to get it into a self-directed vehicle. And so I have one. I will only set those up in my businesses where they're self-directed for my employees and associates. And then you can buy the right things. And I'm a huge proponent of single family and small multifamily right now. Big multifamily is in jeopardy in a way that just because of the rising interest rates has put a cramp on a lot of those projects, which I'm in with some people that you and I know together. So yeah, it's a single family home place. I just talked to a guy this week who's in the Rio Grande Valley, and he can go put up a house, suitable for rent or sale for about $200,000. And if you deploy that $200,000 and you can generate, he's renting those for $1,850 a month.
Wow.
So I mean, that's a great return on new construction build at this point, because people will say, well, inventory has doubled in the past year. Yeah, it's doubled to one of the lowest rates that it's ever been in the history of the country. And that is going to keep prices stabilized, even in the face of an insane, Fed adjusting the curve that way. So it's a very wordy way to say I still like the single family home market. I love the buy and rent. I love the idea that we know that inflation's at whatever they lie and say that it is, at 9% today. But what that means is you can get somebody else to pay you for an asset that's going to increase at least in pace with inflation. There is no better investment for that. Plus, you get the tax benefits. Plus, you get cash flow. There's no better investment out there than that.
Yeah, well, and also it's an affordability issue, right? Like, a lot of the houses that are being built are not affordable to the average, normal American, worker, right? So they're still in that renting game, especially as you're hearing all of these big institutional investors are buying up a lot of the affordable housing to rent them back to, people, right? So it's just going to continue increase the rent, and B, the prices of these homes, because they're going to be able to pay more than what you would as a fix and flipper, because they don't need the returns necessarily as much as you do, right? So I guess
that's exactly right. And again, it's other people's money, right? It's the fact that somebody else is going to pay me to get the benefits of having cash flow and tax advantages, and then I can probably sell it anytime I want to sell it. I'll tell you, one of the strategies that we've employed in the past 12 months is we had about 162 rental homes as a family that we were holding, and we have approached every one of those tenants who are all long-term tenants at protected interest, rates. They have very good rents because we haven't raised them as we should over time. We've gone to them and said, look, we'll sell it to you, but we'll take the note back on it because I don't want to be in the landlord business and the shower curtain rod broke or the oven isn't working or the tree fell down, as much as I want to be holding a capital asset.
Yeah.
And so I'm giving up some of the appreciation on those houses. I know that, but I'm also simplifying life that I just have to collect, a single payment for a note. So we've converted about 50% of that. January 1st, we'll convert about 50% of that block to just held notes instead of landlord-based hold to rent.
Yeah, well, you're simplifying your life, and to your point, you're not getting the calls, or if you have property management, you're not having to pay for the property management because now you're just the bank in that scenario, and you're giving them a house that they know, and you're probably selling it to them at a price that is they wouldn't get if you listed the property, right? You're probably, trying to meet them somewhere in the middle so that they can stay and that you can still make, your interest payment on that. So, the whole seller financing kind of game is super interesting. I talked to a few people that do it mostly in the I talked to a guy the other day that did it in the mobile home park space, because a lot of those people are mom and pop owners, and they still like the cash flow. They just don't want to have to deal with the issues, and that's a perfect way to do it. And they get cash, and somebody else takes care of the asset. So
I love a creative finance deal. I love a seller note. All of that when we're looking at things, those make it interesting. And I'll tell you what we're going to see an absolute mushroom cloud on is sub 2 financing. And people are holding homes at 2.75% interest, and they have to move. So the only reason you're sort of moving right now is because you have to.
Yeah.
Right. Because you've got a good interest rate, you've got a good locked price on what you bought 2 to 3 years ago. If you're moving now, to get an 8.5% mortgage, that's because you have to for a lifestyle. Well, maybe you don't. Maybe you can sub to the existing note and then go buy something with the proceeds. We are seeing a ton of those. Haven't done one lately, but we're seeing a ton of those. That makes sense.
So wait, explain that a little bit more. So what does that mean? Somebody that owns a house that they bought 2-3 years ago, they've got a 2.5% interest rate. What would they do? How does that work?
So you go in and you value the house and you say, I will purchase this house subject to the existing mortgage.
Oh,
and you take over that existing mortgage. Now, the mortgage, whoever's holding the mortgage doesn't want that necessarily. And so there are some, I don't want to call them tricks. It's all legal. It's all above board. And that the mortgagor has the ability to call that note current if they figure out that you're doing that. And in this arbitrage environment where they could cash you out at 2.5% and relend that money at 8%, they may do that. But they have to find out about it. You don't have a proactive obligation, I don't think, to go and tell them about it. So you're seeing a lot of people coming in and saying, look, I want that house. I can pay you $500,000 for it. You bought it for $360 5 years ago, but I want it at that 2.5% note. And then I provide the cash to get that. Then I'm holding that asset at a lower price. I can rent it. I can do whatever I want to on that.
Yeah, no, that's interesting. Yeah, I've heard of subject to in the past, so that's I haven't talked to anybody about it recently, but that's interesting.
Well, it hasn't made a lot of sense because the legacy mortgages were 5% and 7%, so it didn't make a ton of sense on that. But now it makes a lot of sense on the arbitrage between 2.5 and 8.5.
Yeah, and just on the multifamily side, it's not exactly the same, but I'm seeing a lot of loan assumptions when people are selling. They're selling and saying, hey, you can assume this 30-year fixed rate at 2.5%, 3.5%. And that's an attractive thing, especially if you're in the value add space and you've been, bought a variable rate, bridge loan, and now you're paying the price for that if you haven't bought a rate cap. And even if you did, it still doesn't, completely save you. So that's interesting.
That's right. Yeah.
What other kind of interesting deals do you look at as a family office that, maybe the normal human being doesn't get access to? I'm just kind of curious, kind of to peek behind the curtain a little bit to see kind of how that works. And
yeah, I'll tell you what, the sort of the advent and the maturation of technology married with the really low cost of capital in the last, 15 years has allowed a lot of sort of portfolio building to happen. And what I mean by that is, if you have a 401k and you own some public stocks, do you own one? No, you
Yeah.
own multiple public stocks, right? You own an index fund, you own something of that nature. But in early stage company investing, typically because of the way the deals are structured or the way that you find the deals, they don't find you. You might do one or two or three of those over an investing career. That's not a portfolio, and that's a really dangerous way to try to bet on a grand slam,
Yeah.
which doesn't happen, except for 7% of cases. So we love platforms like Republic. We love platforms like Angel List and that sort of thing, because you can go in and you can build a portfolio of early stage startups anywhere you have an affinity in a syndicate manner. And sometimes you can do that for $1,000 an investment.
Yeah.
So we hold a portfolio of about 160, mostly tech startup companies in that vein, where the average check for us might be 25 to 50K.
Yep.
And then we're getting sort of venture size returns. It's a private venture fund that we've put together, basically.
Yeah.
So that's
Yeah.
that's an example of where to go find deals.
Yeah, no, it's interesting. And my wife and I started last year when we moved to Austin, we moved here 3 years ago, but last year we started looking at angel investing, which is kind of what you were talking about, getting in very, very early stage, kind of back of the napkin ideas all the way up to kind of products that are in launch and they need some additional support. And your point, the odds of that, if you just do one, the odds of that one hitting is slim, right? So you need to build a portfolio of investments and look at it that way versus saying, "Ooh, I like this product or this operator. Let me put 50, 100 grand in that." That's probably not the smartest move. Take that and spread it around to 5, 10 deals as opposed to just putting them all in one, as far as that goes. So
yeah, that's right. And it's a tricky thing to do. And people should do that, only with about 3% of their portfolio. So the hypothetical guy we were talking about the other day, that's only $30,000. So if you go down to the local incubator, and they exist almost everywhere now, like chambers of commerce have them and that sort of thing, are you educated enough to know that this company is going to be the one that becomes a unicorn? Now in Austin, very different startup culture, right? So you can throw a rock and hit 9 startups from your window, right?
Yep.
But in other towns, it isn't always the case. Well, you could take that same amount of money, let's say it's 30 grand, and go to AngelList or Republic or any of those sort of portfolio building companies and buy 30 companies, 15 companies, 10 companies, and get a really sort of robust portfolio of deals. Like I'm in SpaceX because they had a syndicate that had a special purpose vehicle for SpaceX, and so that's the way that we deployed into SpaceX. So I'll still get the same linear return. So if it goes public and it makes 20x, my little $50,000 check or whatever it is that we put into it, I'll still get the 20x on that 50,000 if that's the play. Otherwise, I wouldn't have been able to get into that deal because I'm not going to write a $500,000 check to go direct to the company and do it that way. So It's a really good way for people that want to do that. But again, 3 to 5% of the asset class at the $1 million level should be the right number.
Yeah, because I mean that's your high risk bet, right? That's your boom bet. You got to build a platform, a financial foundation of kind of the vanilla real estate stocks, all that stuff that are gonna, hopefully ebb and flow. But then you have these big hits with these, smaller investments but bigger potential returns, right?
Exactly right. Yeah, and you should see about a 30 to 40% compound annual return on that 3% money that you put into that. So that 30K, every 3 years should be doubling, doubling for you on paper, right? Because it's not a fungible piece of real estate. It's not a fungible piece of cash or a bond or something. So there's that to do. And then the last asset class that we look at, just in my personal portfolio, not the family office, but the family office does these deals as well, is we're doing a lot of high coupon debt. So we have a very good partner who goes and does a ton of business development around figuring out what businesses are able to expand but are capital constrained and have early completion. So we just did a 99-acre project in Florida, which is affordable sort of workforce housing for it's a bedroom community of one of the, sort of very ritzy and well-off communities. So this is not the guy that's cleaning the pools, in Celebration, Florida, for example. This is the guy that owns the pool company. So, he's a small business owner. He's going to buy that house for $500,000 to $700,000. It's real things. Well, the developer goes in and he can put, 90 to 120 of those homes in this development that we've secured, but no bank will touch it because it's not titled. It's not, everything put together. The assembly just finished. So we loaned him $2.5 million. A syndicate of us loaned $2.5 million at 17%.
Yeah.
But at the end of the cycle, what did he do? He took that, he refinanced it with the bank at 7%, because then it was something that the bank could take cognizance of. They could look at that as a balance sheet type issue for them.
Yeah.
And so we made, really wonderful money on that, and then immediately took it and redeployed it into the next deal and the next deal. Well, it doesn't take long to double your money at 17%, 15%, 16% a year on things that you are very secure in, so long as the real estate market doesn't get cut in, half like it did in 08 and 09. And I don't see that on the horizon.
Yeah, and I like the diversification. I've started looking at debt funds, which sounds like kind of similar to what you're talking about. Is kind of, you've got these people that need loans. Some of them are fix and flip loans. Some of them are kind of bridge loans, but they're lending at 10, 15, 20%. And then, the person that invests in the debt fund, they get a 8 to 10% return, maybe higher depending on where you sit in the stack and how much you invest. But from my standpoint, I'm like, well, that's interesting, because that, the multifamily space has the allure of, if everything goes right, you get cash flow plus appreciation, right? That's what you kind of think about in the syndication value add world. Well, we've realized over the last year that a lot of people have had distribution stop, right? There's been capital calls, There's been a lot of things. So if you're kind of investing to rely on that distribution, well, that may not ever come. They may still be a good return, but it may all come at the end when they sell, or partially when they refinance in year 3 or whatever. So I'm looking at the debt fund market as like, yes, well, I'm not going to get the appreciation, but I will, assuming the loans are solid and they're not, foreclosed on and all that fun stuff, or defaulted, I'll get cash flow every month, right? Because that loan is kicking off an interest rate. I'm going to get a portion of that. Obviously, the fund manager gets their cut as well. So I kind of like that as okay, this is my cash flow, and then I invest in other real estate deals that are more let me double, triple my money in 4 or 5 years. So that's kind of how I'm starting to think about things, just because I've been laser focused on multifamily over the last 3 years, and some have been really good. Some of them are not doing as well as I had hoped. But I'm not alone in that misery. There's a lot of people.
We're in the same boat, you as well. And you never look at the return of a stock until the day you sell it, right? But in real estate, we tie ourselves in knots all the time about am I doing? It doesn't matter until we exit it. And if you've got the right deal where you've got pref rights and all that kind of stuff, you'll get paid. You just got to catch up with it. And this is just, I feel like this is just a bit of a blip in the world. I'll tell you one of the aggravations that we're having, and our mutual friend that introduced us and I are having this problem together, is evictions. We can't get non-productive tenants out of our very nice complexes in very nice geographies. The court system is either backlogged or in cooperative with landlords in getting people out, and that's not okay. That system is supposed to serve us as well as serve other people, and I don't think that's working as well. So that's been a real shock to me that can affect my bottom line as much as it does.
Yeah, and it is. I've talked to a few people that have deals in areas that historically have been landlord friendly and cooperative. And obviously COVID, every place, had a moratorium and all that fun stuff. But even now, it's taking 3, 4, 5, 6 months just to get the court to hear the hearing and start the process. So yeah, it's almost like zip code to zip code in some areas where some are good, some are bad. in that sense. So, and I know that a lot of people, they buy typically in landlord friendly states just for this simple fact that if people aren't paying, we have a mechanism to move them on and backfill them with a paying tenant. And some of those states are having just as hard time as a non-landlord friendly state from what I've heard.
Yeah. And keys for cash just doesn't work now.
Yeah.
So if I go in and say you're renting for $650 and we're going to rent this thing for $1,300 upon completion of the reno, how much do you give that person? And we've been asked for $10,000 for somebody to move out who simply will not pay because they know they don't have to for a while.
Yeah.
And so even the old tricks of the trade are sort of, not as available or not as conducive as they once were to success.
Yeah. And I know you just shift a little bit here. You wrote a book, a CEO only does 3 things. I'm kind of curious about that. And, maybe give us a little highlight of that book and how it started. But then, I'm always trying to tie things back to kind of how I grew up in a very small town where, we didn't have a lot of money. And I'm trying to think about, you can still think like a CEO, even if you've got 50 grand in your pocket or 10 grand in your pocket or 2 grand in your pocket.
And you should do so.
Yeah.
And that's one of the big arguments of the book. So, I found myself in the CEO's chair of our family business when my dad very unexpectedly passed away at 52. And so I had this whole other career. I'm an attorney by training. I was in the venture capital industry for many years. I worked in-house at some of the biggest companies on earth, helping them figure out and execute a venture capital and investment-based strategy. And then my dad passes and it's like, there's nobody to run the business. Come home and run the business. And so I did that. And, I remember the first day, it was Valentine's Day of 2005. And I closed the door to my new office. That was my dad's old office. And I sat down and Googled, how do you be a CEO? Because I didn't know. I'd always worked for those guys, and I was privileged to be able to be in the room and in the boardrooms and things like that. But that's not the same as when you have to meet payroll and you have to take care of your obligations. And so I had a legal pad on my desk for the first 2 years where I just wrote down everything that I learned and then sort of synthesized it into something. And my thought process at that point was somebody's going to take this over from me and I'm going to go back to my great life that I was living. That didn't happen. But I wrote it so that I would have some instructions or at least like a little, how presidents leave the next president like a letter to say, here's how I was the president or whatever. I kind of wanted to do that. And then I began consulting with people in my end, kept saying like, you ought to write a book. But when pandemic just slammed everything shut, I thought, if I'm ever going to write a book, this is the time to do it because I'm stuck at home anyway. So I did that. And so I make several arguments in the book, but number one is being a CEO means that you're the one in charge who gets to decide where your focus goes. And very typically, if you run an organization, then, your focus has to be on convincing the people to follow the same mission. If you run a single purpose entity, a single person entity, it's the same challenge. It just should be a little bit easier because it's you. So the CEO is paid to do things that nobody else can do, meaning have the authority to do, and no one else has the responsibility to do. And those 3 things are culture, people, and numbers. And so, as far as a single person or maybe a person with an assistant or something of that nature, you still have a culture in which you want to, to build a business. And does that mean, hey, my culture is we don't work on Friday after 5 o'clock, or, when we close a big deal, we tithe and we go for a massage the next day, or, we have a culture where we don't lie or obscure facts to buyers. It doesn't matter what those values are, but having a very conscious appreciation for what those values are, and this is how we're going to make decisions and live our lives. That's the culture piece. People is recruiting, which very, very well, is recruiting and then retaining the right people to go on that mission with you. Now, if I'm a single individual, well, Trey, I don't want to have employees. Great. But does that mean you inspect every property that you have? Does that mean that you appraise every property that you have? Do you bank every property? No. You have to assemble that team, even if they're just contractors and sometimes are on the team. Assembling that team and getting the right team and then taking care of them and appreciating them is very important. And then, and being conscious of that. And lastly is being conscious of your numbers. What are you trying to get done here? As a family office, we get pitched deals, every day. We just onboarded an employee to help us start, really getting consistent on how we respond to those deals. But we don't hear two pitches from somebody that doesn't know their numbers on the first pitch.
Right.
So if you don't know, if I ask you what were the taxes last year and you don't know that because you haven't looked it up yet, it means that the deal's not baked and ready, and you probably aren't either. Well, if I'm running that deal for myself, this latest fix and flip that I want to do, or a wholesale deal or something of that nature, I have to hold myself to that same standard.
Yeah.
So I got to know my numbers of the operating business, and then I got to know where I'm trying to get to. And I have a target return every year that I want to hit. I have a net worth increase that I want to hit every year, whatever those KPIs are. That's for me to do. And when I'm in a bigger organization, it's for me to share those goals with everybody else in the organization. Culture, people, numbers. That's the CEO's job.
Yeah. And I think, as a solo entrepreneur at the moment, I have an employee starting on Monday, which I'm pumped about for my recruiting business. Well, it is true. Like, even though my culture is me, right, I still have to set my own schedule and my own focus. And, I also have to, one of the benefits of starting your own business is you get to sometimes pick who you work with, and that includes clients, right? So I enjoy when I, say no to a client because they don't fit my values. And you have the ability to kind of pick and choose, right? And so I think, to your point, whether you're running a business of 1 or 1,000, as a CEO, as a runner of that business, you still need to hold yourself and accountable. And the people part, to your point, is your vendors, your partners, your suppliers, all that stuff. So
that's exactly right. Your contract. I mean, my contractor is the most important member of that team for me, because I've been through them all, and I've got a guy now that I can say, I taught him, this is how we talk about ARV, right? These are the numbers. So I can send him to look at a property that I never even visit. And he comes back and says, I can put this in and you'll get an ARV, and here's your return.
Yeah.
And he and I have JV'd a couple of properties because he sees how sweet they are. But he's an important member of my team, and I take care of him in a great way. His son goes to a certain college that we absolutely hate because of football rivalry. But during the rivalry game, like, I made sure that the kid got tickets into the sort of VIP area where he wanted to be. That's one of the ways that I take care of my contractor and take care of my teammate.
Yeah. It's interesting. Well, we've been chatting for about 40 minutes now, and I'm kind of curious, as we kind of wind to the end here, what are you seeing, or what are you being pitched that may be different than what you were getting pitched 2 years ago, because the world is much different. Capital is more expensive. I'm just kind of curious. And maybe after that, what's your kind of vision for 24 and all of that? Where can people see some maybe outpaced returns based on, what you're hearing? Because you obviously have a closer ear to some of the creative deals that are out there than maybe the average Joe.
Yeah, I am. If we stick just to real estate, I'm a huge fan of 4 and 8 and 12 plexes, sort of mini multifamily.
Yeah.
I love the returns on those. I love the fact that they can be managed really well. I love the fact that you can, with a very little amount of money, impact the beauty of the place, increase the rents, and those kinds of things. And you aren't stuck in the large corporate world of 3,000 doors or something of that nature. So those are always harder and harder to find, but I'm a huge fan of those. I'm a huge fan of any duplex that I can get my hands on, because I can go vacant on half of a building and still make my note payment and obligations, and everything else is gravy. I love those things too. So we build those and we buy them pretty much anywhere we can get our hands on them. And then I love the fact that, for some people in our lives, we will help them get their first home purchase in a duplex, and let the tenant, on the other side of the wall, pay the note for them and live that way for 3 to 4 years or 2 to 3 years. So I love that space completely.
Yeah.
So that's my real estate answer. And we are continuing to look for those where we can find them. In the other world, I think that we have reached multiple crest, which means, I think that most businesses that are going to be purchasable are going to be purchasable for less money in the future than they are today. So I think we'll see some retrenchment on that. So if you've had your eye on a high cash flow muffler shop or something of that nature, I think you'll be able to buy that for a lot less money in 2 years from now than you are today, if that's one of the ways you want to build a cash flow business. I'll tell you the surprise for us this year is, when you invest in early stage startups, you understand that about 40% of them are just going to disappear.
Yeah.
We have stepped in this year and purchased 2 and almost purchased 3 of some investments that we had made that were failing. And we knew we are going to go to zero. We stepped in and said, look, we'll buy the assets. And so one of those deals we bought for about $20,000 plus sweat equity. And we have an offer, we have a term sheet on $4 million for that right now. Now, super contingent and 10 things have to happen. And I don't hold a lot of confidence in that offer. But if it comes through, I mean, you can't get a return like that on anything. Like you have to discover oil in the backyard or something. So, but I think we're going to see a lot more of those. And so we are in a planning session on Friday of this week with my team to say, hey, how much of this cash do we need to allocate to these special situations? And just to tie in a little bit to that, the other thing that we're seeing pitched a lot more now than we were 6 months ago are these distressed opportunity funds, these turnaround funds. So in real estate, you see them. In PE, you see them as well.
Yeah, I'm also curious. I've been talking to a friend of mine that he's been thinking about kind of roll-ups in the kind of services industry. So plumbers, HVAC, roofers, because no matter how much technology we make that helps our lives kind of do what we're doing now, we still need somebody to fix the toilet. We still need somebody to fix the HVAC system. Robots aren't able to do that at the present moment. So, and a lot of these services businesses are mom and pop, they're boomers. And so they're at the point in their life where they probably are like, I don't want to do this anymore. And they also don't want to grow their business, right? They have a steady Eddie business. It's them and maybe 2 other people or something like that. And they make a comfortable living. But now they're like, well, I don't want to go through another downturn, right? I don't want to do that again. So have you been pitched kind of those types of opportunities in the sense of like, hey, we're going to go out, we're going to raise money, we're going to buy 30 of these HVAC contractors in a given market, rebrand it, and then run it, and then sell it to a larger PE because they want to get into that business, but they don't want to do the roll-up. They don't want to do all that work.
Yeah, so that's been a mainstay of the world since capital got cheap. It's interesting that you don't see a lot of successful roll-ups in the strategy that you're outlining. Where you see the successful startup is the guy that says, I'm going to be the platform. And I'm going to bootstrap and go and get, I'm going to go buy the local HVAC company. I'm going to work in that company for 2 to 3 years and take it over and figure out, who's good, who's costing me money. Should the previous owner's sister still be running bookkeeping here, and make those choices and employ technology a little bit and that sort of thing. And then you grow that to buy a second and a third and a fourth, which is largely what we've done, a private roll up in the insurance space. So we bought and sold books of business, other agencies along the years. And, we buy that at a 5 multiple and, potentially can sell it at 12 to 14 multiple. That's a pretty good way to do it. But I'm paying attention to the bottom line cash flow.
Yeah.
So I bet we get pitched a roll up a week on the other model that, I'm not really in the space, but I can see the numbers and they're really good. I want you to give me $4 million to go out and roll up 4 of these companies and that sort of thing. I'm not saying that doesn't work. It's just few and far between where I see that they make the splash that they do. Now, interestingly, both Carta and AngelList now have a roll up product.
Interesting.
You can buy from them. It's all the legal work and a ton of the accounting work done for you. So I think you might see some efficiencies created there, and that's interesting. And I do love the underlying premise of that. And I would invest in the right one. I just happen to be investing in the one that I know the best, which is the insurance space right now.
And what kind of insurance is it?
We largely do employee benefits.
Yeah. Oh, got it. Very
health insurance and supplemental insurances and things like that. But there's always a roll up going on in property and casualty insurance. Always.
Yeah. No, that's interesting. Trey, it's been awesome talking with you. I want to kind of round out the conversation here with the 3-pack of questions that I ask every guest. So this one's going to be a little bit different because you've kind of been in the family office space, but you do real estate. So what is one piece of advice that got you started or helped you along your real estate journey?
I don't know that this will be popular advice, but it is accurate. My dad told me if you can't afford to put 20% down, you can't afford the real estate. He has been right on that when the money has turned south.
Got it.
It isn't to say that I can't, make something float for the day, but when that tenant moves out, especially in big commercial projects or something like that, the biggest personal deal I ever did was an office building that I bought in 07. And I had to fund that out of pocket. And I bought it because back in those days, I could call the banker and say, it's $1 million. I want $1 million. And he'd give me $1 million. Well, I would have been in much better shape if I had put 200K down on that deal, largely because I didn't have the 200K liquid at that point. So I couldn't have done the deal. And I wouldn't have had that problem happen,
right,
for the next 3 to 5 years on that, where I was subsidizing that out of my pocket to the tune of $10,000 a month sometimes.
Yeah.
So it's a good rule of thumb. I'm not saying you have to obey it every time, but that's been one of the biggest pieces of advice that when I didn't follow it, I felt bad about it.
Got it. No, that's interesting. That's interesting. All right. What is your favorite real estate or business book that you're into right now, other than the book that you have?
Obviously, my book is the one that I obsess over, of course. Look, I have a personal habit. For 23 years, I've read 100 books a year. And so It is really hard for me to say what's my favorite. But I go back to a handful of books all the time.
Okay.
Obviously, Rich Dad, Poor Dad is something that everybody has read and should read with your kids, because you want to change their mindset to escape a trap before they get into it. That's obviously one. I read The Alchemist every year. That's a mind seasoning book that I think is incredible. I think Traction is incredible. I think Profit First is incredible. Every time I get sideways financially with some endeavor, I look and it's like, you're not doing profit first. And so I have to discipline myself to come back to that every single year. There's another book called The Goal. And every MBA student on earth reads that book in their MBA program. It's a professor that wrote it. And it's one of those sort of fables or novelizations almost, where they tell a story, but you're getting the learning from that story. I think that is good. You're not allowed to work for me until you've read that book. So I give that in the interview process, that if you get the job, you have to have read that book before you start. The last one is a book that I love. I know the author, and I think it's really fabulous. And it's called Linked. And it is all about the way that we think about networks and how you can monetize a network, but it's the raw science behind networks.
Okay.
Super interesting book. I just emailed him. That book is probably 10 years old. And I emailed him earlier in the year and I said, are you not bringing a second edition of this book? And he sort of moved on to some other stuff. And I'm like, dude, I wish you would do it. I'm not going to do it, but I wish you would. So Linked is another really good book there.
Got it. This last question may be relevant, may not be, but I'll ask it anyway because I ask everybody it. If you hit your financial freedom number, meaning you can live an amazing life just off the passive income from your investments, what would you do?
My wife and I would move to Italy for 1 year. We have this in the plan. We were supposed to do that May of last year, and then she got pregnant with our third baby.
Got it.
So we have a 13, 11, and a 1-year-old now. And so that was a surprise, a good surprise, but it knocked us off our plan for that standpoint. So we pretty much are at our financial freedom number at this stage. And so that is the plan for us, is to go live in a foreign culture so that our kids grow up with a little bit of enlightenment, because we live in a small town now and I want them to see that other people live and think differently. So that's a really big thing for us. Yeah.
Awesome. Very cool. Well, Trey, it's been awesome talking with you. If people want to learn more about you, they want to, pick your brain, whatever, what's the best way to kind of connect with you?
Yeah. So if you like the kinds of things that we've talked about, I do a newsletter that's plantyourflag.com. live, and it's the Substack. It's free. I'm never going to charge for it. We've got about 11 or 12,000 people that read that. And, I'll get up one day and it's really, I'm writing for myself. I'm working things out for myself. So I talk a lot about what the Fed is doing and what the money supply rate is and those kinds of things, which I try to demystify for myself.
Yeah.
I do a little bit of demographics and economics and things like that. I don't do politics in that newsletter. I'm a political person, but I don't think that that's conducive to the discussion that I want to have there. So I do a lot of that sort of, armchair economics in that place. Obviously, the book is on Amazon. It has a workbook that the publisher just ordered, and it has an Audible that the publisher paid for earlier last year. And the book's doing super well. We thought we'd sell 50 copies or 500 copies, and we're at 60,000 and going now.
Congrats.
So it's a popular book. It's a cult classic in the Inc. 5000. Like CEOs buy it and give it to people in the Inc. 5000. And then you can go to any of my websites, trey-taylor.com, or my consulting company is trinity-blue.com. And I work with a lot of sort of, solo entrepreneurs to look and get super clarity on where am I trying to go and how can I do it in the constraints that I have. And that's a time and materials type consulting thing. And then I work with CEOs. We do 12-week sprints with CEOs who want to sort of get in control of their businesses again.
Awesome. Very cool. We'll have a lot of that stuff in the show notes, but Trey, man, really nice to meet you. Awesome podcast. This has gone in a lot of different directions that I never thought I'd have somebody on talking about an MLB expansion team. So check the box on that one.
Yeah. So fingers crossed. Yeah.
Awesome. Thank you very much, Trey. I appreciate it.
Thanks, Justin. Great to be with you.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast, your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please leave a written review. I read every review as it helps me serve you better. If you're listening to this podcast, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.